Okay, welcome to the deep dive. Today we're tackling the latest Costco numbers, Q4 and the full fiscal year 2025.
Right. We've got the results, the analyst takes.
And we're going to unpack what's really going on behind those headlines.
Exactly. Because, the big question here is why a company can beat expectations, look great on paper, but the market kind of shrugs or even dips a little.
Yeah, let's start right there with the beat itself, because Q4, the 16 weeks ending August 31st, looked, well, pretty strong.
Definitely. Earnings per share, EPS, came in at $5.87.
Which beat the $5.80 expected.
Comfortably beat it, yeah. And the top line followed suit. Total revenue was $86.16 billion.
Just sneaking past the $86.06 billion estimate.
A narrow beat, but a beat nonetheless. And the net sales figure itself, $84.4 billion for the quarter. That's up a solid 8.0% from last year.
Okay, so beat on earnings, beat on revenue, decent growth. Why the hesitation then? What's causing that tension right after the report?
Well, it really boils down to one word,
Yeah.
valuation. Costco's stock, it's had an incredible run over the last 5 years, just phenomenal.
Right.
So when a stock is trading that high, investors have already baked in a lot of good news. They expect perfection, basically, and they need a really clear reason to push it even higher.
So the beat was maybe already priced in?
Largely, yes. So analysts, the market, they're listening past the history. They want signals about the future, and they're really focused on two things: membership income trends and how things look for, discretionary stuff, non-essentials.
Got it. That makes sense. So if the headline numbers aren't quite enough to justify that premium price, we need to dig deeper into the membership base. That's the real engine, isn't it?
Absolutely. That's the bedrock. And it looks, frankly, incredibly strong. Membership fee revenue
Grew 14.0% in the
well, 14% just on fees.
Just on fees.
And even if you strip out the noise from foreign currency fluctuations, the FX impact, it's still up 13.6%. Really robust.
That's huge. And how many members are we talking about now? What's the total count?
They hit 81.0 million total paid memberships. That's up 6.3% year over year.
Okay.
But here's the kicker. It's not just the number of members. It's how loyal they are. The worldwide renewal rate, almost 90%. It's 89.8%.
Wow.
And in their core market, the U.S. and Canada, it's even better, 92.3%. People just don't leave.
92%. So once you're in, you're basically in for good. Which brings us to the premium tier, the executive members.
Exactly. The really high value group, they now have 38.7 million executive members.
Yeah.
And this group, this is key, they account for 74.2% of sales penetration.
Okay, hold on. 74% of sales come from executive members.
Nearly 3/4 of every dollar spent comes from that top tier group who pay more for their membership.
That's impressive concentration, but doesn't that raise a flag? I mean, if almost 3/4 of your sales are already tied to your best customers, where does the next big jump in growth come from? Is there a saturation point there?
That is exactly the right question. And, if their only path forward was just getting more executive members, yeah, maybe you'd worry about a ceiling.
Right.
But that high penetration actually changes the narrative. It lets you see Costco differently. It supports this idea, this insight, really, that Costco is less like a traditional retailer fighting for tiny margins on goods and more like a service provider funded by these super reliable, high-margin membership fees. That fee income stream, it's predictable, it's profitable, and it kind of de-risks the whole retail side of the business.
Okay, so the argument is the fee income justifies the high stock price, almost regardless of whether they sell, I don't know, fewer TVs or patio sets in one quarter.
That's a big part of the bull case, yes. It makes that $84.4 billion in quarterly sales look a bit different.
Right. So let's talk about how they got that $84.4 billion. The comparable sales growth, how did that look?
Very healthy. If you adjust for gas prices and FX, total company adjusted comp sales were up 6.4% in Q4.
And what drove that 6.4%? Was it higher prices or more people shopping?
It was a mix, but importantly, it leaned towards traffic. Traffic, meaning the number of shopping trips, was up 3.7%.
Okay.
And the average ticket, how much people spent per trip, that was up 2.6%.
So more people are coming through the doors more often. That sounds like a strong signal.
It really is. It shows engagement, loyalty. People see Costco as essential, not just a place for occasional big shops. They're visiting more frequently.
And what about online? E-commerce often gets talked about as a weakness for Costco, but these numbers look different.
Yeah, they're definitely accelerating there. Adjusted e-commerce comparable sales surged 13.5% in Q4.
13.5%.
Huge jump. And it's not just random. Site traffic was up 27%. They specifically mentioned things like improving the search function, using data augmentation, even putting in like an online waiting room for hot items.
Like for sneaker drops, but for Costco?
Sort of, yeah. It shows they're serious about making that digital channel work for their members.
And internationally, how's the model translating outside North America?
It translates incredibly well. That's another key growth story. Unadjusted sales growth in the U.S. was 5.1%, Canada was 6.3%. But the other international segment
Yeah.
led the pack at 8.6% growth in Q4.
Wow. So the model definitely travels.
Absolutely. It proves that core value proposition, bulk items, low prices, membership fee, it works globally. Big green light for more international stores.
Let's go back to that e-commerce number for a second, the 13.5% growth. What were people actually buying online?
Ah, yeah, the category list is fascinating. Top drivers were gold and jewelry.
Gold online, okay.
Yep. Then housewares, tires, apparel, sporting goods, majors think appliances, small electrics, and garden patio.
That's quite a mix. Gold and majors sound like high-ticket discretionary spending. Confidence there.
Exactly. Shows those executive members are still spending on big items. But you also see tires and housewares high up.
Necessities, basically.
Right. Practical stuff, maybe things you buy less often but are high value.
Yeah.
It suggests people are using online for both splurge items and essential but maybe bulky replacements. Very resilient.
Okay, shifting gears slightly. How efficient was all this selling? Let's look at margin.
Sure. Gross margin was reported at 11.13%. If you exclude gas, it actually improves slightly by 3 basis points.
3 BPs. Tiny, but positive, right? Especially with inflation.
Exactly. Holding or slightly improving margins in this environment is a good sign, shows discipline, probably good vendor negotiations.
And what about overhead? SG&A, selling, general, and admin costs. Did those creep up?
Nope, they actually managed that really well too.
Yeah.
SG&A improved by 9 basis points, excluding gas.
Improved, meaning it went down as a percentage of sales.
Precisely. That's favorable. It means they got more efficient as they grew, they achieved operating leverage, and all this efficiency translates to cash.
Right.
For the full fiscal year, net cash from operations was $13.335 billion.
Yeah.
That's way up from $11.339 billion last year. Strong cash flow.
And that cash fuels the future, right? Building more warehouses. Where are they now and where are they going?
Currently, 914 warehouses globally.
Yeah.
And the plan is to hit 944 by the end of fiscal year 2026. So 30 net new locations planned over the next year or so.
30 more. Where are they putting them?
Interestingly, 20 of those 30 are planned for the U.S. Shows they still see plenty of room to grow domestically, and they just opened stores in Q4 in Malmo, Sweden, and Allen, Texas, expanding internationally and domestically.
Okay. And finally, every company mentions the risks, the standard forward-looking stuff. What were the main external pressures they called out?
It's the usual suspects for a global retailer, but still important. Things like domestic and international economic conditions, so exchange rates, inflation, deflation, geopolitical issues, tariffs hitting sourcing costs,
Makes sense.
and of course, rising costs for employees, wages, energy. These are just the realities of the operating environment they have to navigate.
So let's try to wrap this up for you listening. The takeaway seems to be Costco delivered financially. The membership core is incredibly solid. E-commerce is really picking up steam.
Right.
But that high stock valuation keeps the market demanding more, asking questions.
Exactly. And that strong membership growth, that 14% jump in fee income, combined with the huge 74% sales penetration from executive members, it reinforces that core idea we talked about.
That they're becoming more of a service provider.
Yeah. A service provider funded by these reliable fees, that just happens to sell merchandise, almost like a perk of the membership. It's a different way to view the business.
That really is the key insight, isn't it? The strength and predictability of those fees suggests serious pricing power and loyalty, almost like an annuity stream. So the question for you to think about is, does that reliable fee income justify the premium stock price, even if sales of, say, discretionary goods fluctuate quarter to quarter?
That predictable fee stream might just be the fundamental reason Costco continues to command that high valuation, regardless of bumps in the retail road.